Hi guys, welcome back. I'm sure you're full of people happily sitting on your investment holdings or property collecting passive income. So to slowly but surely build your passive income, I'll be making a two-part video focusing on the various instruments that I personally use to build passive income. So in today's video, I'll be sharing with you 3 real estate investment trusts or REITs to build your income in today's economic climate. So since some of the wealthiest people in Asia have built their wealth through properties, no matter what, investing in properties is one of the ways to build wealth and passive income. However, not all of us can go and buy investment property, and even if we can do it, it is actually quite troublesome when we get into the details, right? You have to find your own tenants, maintain a property, and navigate the various taxes and stamp duty along the way. So that's why, to me, REITs are a perfect way to get you started to grow your passive income. And for those living in Singapore, the good thing is that the dividends are actually automatically transferred to your bank account, something like this. So without further ado, let's get straight into it. So first up, we have Keppel DC REIT. So Keppel DC REIT is a specialized 4.8 billion real estate investment trust that is listed in the Singapore Stock Exchange. And Keppel DC has 18 data centers, mostly in Asia. 6 of its data centers are actually here in Singapore. So you might ask, what exactly are data centers? It's all in the hype nowadays in the news. And a quick summary is that data centers are massive dedicated spaces for high-powered computers. So these systems actually run enormous amounts of data, from streaming your online YouTube videos to surfing your Facebook and TikTok. And with or without this pandemic, we know that digital content is growing, and that's why most of its tenants are actually internet companies, telecom operators, and IT services. And because there's so much demand for data traffic flow, tenants today need to make sure that these spaces have specialized, reliable equipment, for example, cooling systems and various other infrastructure, to make sure that nothing actually goes wrong, to make sure that the service they provide to their end customers are actually reliable and stable. Keppel DC REIT knows that it's going to benefit from this huge growth in the new digital economy. So in fact, people today, they're actually going more and more into cloud adoption, artificial intelligence, 5G, and the Internet of Things. And in fact, these are expected to grow at least double digits for the next decade. So according to its financial reports, data centers in APAC is expected to exceed 30 billion by 2023. So in fact, Keppel DC REIT has ride this digital wave very well and has been rewarded handsomely as well. So since its IPO, Keppel DC has more than tripled its free cash flow, and this allowed it to reward growing dividends to its unit holders every year. Now in fact, when you look deeper into its balance sheet, 70% of Keppel DC's gross rental income has a shorter 3-year lease. And what this means, right, is that this allows Keppel DC REIT more room to adjust for higher rents to capture the growing demands for data center. So imagine if, let's say, we were to rent a condo. Every 1 year or two, when the landlord actually comes back to recontract the rental, and every year without fail, we all know that the rental will always go up. So imagine this being done to the internet companies every 3 years to something as crucial as a service to store their data of their customers. So even with its huge growth, Keppel DC maintains a healthy financial positions, and banks know that Keppel DC actually holds a very high quality assets and are willing to lend them at a low borrowing cost of 1.6% per year. And this makes Keppel DC REIT maintain a very high interest coverage ratio of about 13 times. So since its gearing ratio is only at 35%, what this means is that Keppel DC REIT actually has a lot of room to acquire and grow. And acquire and grow they did. So recently, they actually completed an acquisition of a Keppel DC Dublin 1 in Germany. And very recently, they actually did an acquisition in China. So of course, one key risk here is that growing competition with other data center providers globally. Another key risk here is that very recently there has been an expansion of the mandate of Keppel DC REIT. What this means is that Keppel DC will no longer be a pure data real estate investment trust. So as now it will include real estate and assets in the digital connectivity sector. So Keppel DC REIT's official reasons for this expansion of mandate was that it will allow them to continue to invest in assets with stable cash flows, attractive yields and good returns. However, here when we look into it deeper, right, I think something that investors have to be comfortable with is that what is the primary purpose of this expansion of mandate, right? As shortly after this expansion of mandate, they actually had another announcement to actually buy into M1 network asset. So here it's important for investors to be comfortable whether or not Keppel DC REIT expand its mandate to actually purchase M1 into its portfolio, or was it the other way around, whereby they actually had the intention to purchase M1 and they actually expanded its mandate later on, right? So I mean, it's for everyone's guess, but when you dig a little bit deeper, you see that M1 is actually a subsidiary of Keppel Corp. Likewise, obviously, Keppel DC REIT is also linked back to Keppel Corporation. So yes, Keppel DC REIT has kept its investment into M1 at 2.6% of its total portfolio, and it has said that such infrastructure investment will unlikely be more than 10% of its total asset. Right? However, with this expansion of the mandate, Keppel DC REIT actually ceased to become a pure data center play, right? And one of the risks here is that it should not be trading at such a high premium where this sector is usually at. So another key risk here for Keppel DC REIT is that Singapore will temporarily halt new data centers development, because data centers, they actually consume a lot of energy. So as demand for this infrastructure grows, emission issues is expected to arise. Data centers are estimated to consume 1% of the global electricity consumption. And in fact, in Singapore, this is much worse. Data centers in Singapore actually used up 7% of the total electricity in 2020, which is a significant amount given our power constraints. So as a result, the government has temporarily halted the construction of new data centers to address the problem before this whole thing actually goes out of hand. What I believe is that in the short run, it will actually benefit Keppel DC REIT, because a lot of these tenants would actually renew their contracts with Keppel DC REIT as there are no new data centers that will be popping up. However, in the long run, this is something that we need to take note of. The next REIT that I'm going to talk about is something that is actually close to all of our hearts, and that is CapitaLand Integrated Commercial Trust, or CICT. CICT was formed after a merger in 2020 between CapitaLand Commercial Trust, CCT, and Capital Mall Trust, CMT. CCT and CMT actually merged to grow to the biggest REIT in Singapore and third largest REIT in Asia. So today, CICT is a 14.3 billion retail, office and integrated REIT behind Hong Kong's Link REIT and Australia's Centre Group. So this public listed Singapore REIT started from just 3 properties: Tampines Mall, Junction 8 and Funan Mall when it first listed in 2002, to 24 properties today, including 5 integrated developments. So the thing is, more and more real estate investment trusts are going into mixed developments like CICT, combining both retail and office spaces in one area. So if you think about it, I believe that this model really works in Singapore, not just because we have a limited land space, but many properties, when structured like this, have become a more efficient way to provide people with a convenient work-life environment by combining both retail and office spaces in one area. So although more and more REITs are following into CICT's footsteps, I believe here the secret sauce that sets CICT apart from the rest of the competition is what they call Asset Enhancement Initiatives, or AEI for short. And what this means for a layman, right, is that it can take a very old building and change it into something very innovative and trendy. Right? So for example, CICT actually took one of its quiet consumer malls and actually transformed it into one of the most hip and busiest retail malls in Singapore. And of course, this mall that we are talking about is our Funan Mall. So Funan Malls previously was actually a very quiet place when not only the tech enthusiasts would go to get certain products, but today, after asset enhancement initiatives, it holds more than 200 brands, with at least 30% of its stores a flagship concept store. And according to CICT's financial reports, monthly shopper traffic actually rose more than 70% compared to its previous generation. The key thing here to note is that the space is the same, and even though CICT did not expand Funan's mall net leasable area, and what this means is that the amount of space being rented out to tenants is the same. The property valuation actually more than doubled from its asset enhancement initiatives. And when you look at this trend of CICT's track record, here to me, this is the greatest secret sauce of CICT and the greatest value it provides to a lot of its retail malls. So for CICT, Funan Mall is not the only asset that has been enhanced successfully. They also actually took a lot of other iconic malls like your Deep Bugis Plus and JCube, right? And CICT has rewarded shareholders with increased dividends in 2019. But of course, because of this COVID pandemic, it has been a tough time for retailers, and CICT had to slash half of its dividends and paid out about 6.95 cents per share. And this caused with its dividend yield to be about 3.2%. However, I personally am not concerned about this because in the long run, I believe that CICT's dividends will rebound and they'll be able to grow year after year because of the various different initiatives that I shared with you. Not because it's Singapore's largest REIT, right? But because of their ability to actually transform retail and office properties to meet the needs of Singaporeans, to meet the needs of the population, and to understand what actually makes a good property profitable. So if this video has been helpful for you, do click on the like button and also click subscribe to be notified for my future videos. I spent a lot of hours practicing and also researching this video, so a subscribe and a like will mean a lot to me. So the third REIT that I believe that should be on your radar is Parkway Life REIT. So developed countries, right, all of us face one common and very big problem, which is an aging population. So in Singapore, we currently face an increasingly aging population caused partly by an increased life expectancy. We are living longer and longer, coupled with lower birth rates. So in fact, by 2035, it is estimated that about 32% of Singaporeans will be aged 65 and above, while the median age is also expected to rise from 39.7 in 2015 to 53.4 in 2050. And of course, the government is very worried. And if you look at a lot of government schemes, they are actually more and more channeled towards this aging population, right? To this group of people that are aging. And because of pure demand and supply, healthcare costs is going to go up because it is very important to take care of our elderly in a developed country. And that's why Parkway Life REIT is actually positioned very well to take advantage of this market situation. Now, Parkway Life REIT has a diversified portfolio of about 53 properties and owns not just some of the private hospitals in Singapore, but also some of the top nursing homes in Japan. And you think, why Japan? If you look at Japan's population, Japan has the highest old age dependency ratio of all the OECD countries. And what this means is that 1 in 3 people in Japan will be over 65 years old by 2050. And although this is a much smaller REIT than a lot of other Singapore REITs, I believe that this is one of the most high quality healthcare REIT that you can get in the Singapore Stock Exchange. Because we know that people die, but healthcare spending will never die. So Parkway Life REITs owns 49 properties across Japan, and a lot of them are actually located in a very well populated cities. And all of these properties are actually fully leased to various different operators of nursing homes, with the big operators contributing more than 50% of its Japan income, right? And these are long-term leases and they expire in like 10, 11, 15 years. And a lot of these properties, right, owned by Parkway Life REIT, they have a yearly rent review. And in Singapore, right? We know that Parkway Life REIT actually owns some of the private hospitals, for example, Mount Elizabeth Hospital, Gleneagles, and also Parkway East Hospital. And whether or not there is a pandemic, the demand for healthcare is very important, right? And if you recall previously, a lot of very rich and powerful people will actually fly over here to Singapore to get treated in our hospitals. These hospitals, when you look at the balance sheets, they're actually master leased to IHH Group. So they are one of Asia's largest public healthcare group, listed in both Singapore and Malaysia. So for Parkway Life REIT, their gross rental income is split relatively equally between its Singapore and Japan assets. So you have to be comfortable with being invested in healthcare facilities in both of these countries. One additional thing here to note is that Parkway Life REIT's properties, they actually provide a very predictable form of cash flow, right? Free cash flow, when you look at the balance sheet, has been very stable, growing from 65 million in 2010 to about 80 million in 2019. So since its IPO in 2017, there was stable growth in its DPU. And this is the annual rent revision in action and how it benefits the REIT unit holder. And therefore, this gives income investors a very stable form of dividend or passive income. And when you look at its track record, if you have held Parkway Life since its IPO, you have made an annual return of close to 11%, including its dividends, making it actually one of the best performing Singapore REITs. So if you have zero real estate investment trust exposure today, then averaging in would make a lot of sense. And if your strategy is to dollar cost average over the next 10 years, then market timing is not really very important. It's not very important on when you buy, as long as you buy in at regular intervals, right? However, if you're like me and you have bought up a lot of REITs in 2020, that's where you might want to look into other sectors, which I will be going through in my next few videos. So be sure to subscribe and like this video so that you will be notified. So if you'd like to learn more about personal finance, adulting tips and life in general, be sure to click on these two videos and I'll see you in the next one.